You open an app. You have $100 sitting in it and a decision to make. Do you buy the stock everyone on your feed is talking about? Do you wait? You don't really know. You just have a feeling. And somewhere right now on a server farm you'll never see, a machine is looking at that exact same decision with none of your feelings at all. It runs the numbers. It picks. No hesitation, no gut, no dread. So here's the question that should bother you a little. If a machine can make the same decision you're making, minus the fear, minus the excitement, minus the ego, does it actually do better? The honest answer is far stranger than computers are smarter than you. It isn't about intelligence at all. It's about something else entirely. And once you see it, you'll never look at your own trading decisions the same way again. Let's start with the strangest true story in modern finance because it sets up everything else. In the 1980s, a mathematician named Jim Simons walks away from a successful academic career to start a hedge fund. He had no background on Wall Street. He didn't care about any earnings calls or company fundamentals or gut instinct. He built a firm called Renaissance Technologies and he filled it with physicists and code breakers instead of traders. Their flagship fund, called Medallion, went on to average returns of over 60% a year before fees for 3 decades. Nothing else in the history of investing comes close. Warren Buffett doesn't come close. So what was the secret? Was it some brilliant prediction about the future of the economy? No. And this is where it gets interesting. One of the firm's own leaders once said something that sounds almost like a joke, except it's completely true. He said the fund was right about 50.75% of the time. Not 90%, not 70, 50.75, barely better than a coin flip. But they made that tiny edge on millions of trades over and over at massive scale with total consistency. A coin that lands in heads 50.75% of the time will make you rich if you flip it enough times and never let a bad flip shake your nerve. Sit with that for a second. The most successful trading operation in history wasn't built on genius predictions. It was built on a small, repeatable edge, applied with zero emotion over and over again, which raises an uncomfortable question. If the best quantitative fund on the planet is only right about half the time, what does that say about you? Guessing based on a feeling. Here's what most people don't realize about their own investing decisions. It isn't that you lack information. You probably have more financial information available to you right now for free than any investor alive 50 years ago. The problem isn't access. The problem is what happens inside your head the moment you have money on the line. A researcher named Terence O'Dean spent years studying this exact question. He looked at real trading accounts, tens of thousands of them, to find out whether people who traded more often actually made more money. You'd assume more attention means better results. More research, more decisions, more control. The opposite was true. The investors who traded the most frequently earned the lowest returns of anyone in the study. And it wasn't a small gap. The most active traders underperformed the market by a wide margin, while people who barely touched their accounts did far better. Why would doing more make you worse off? Odine's answer comes down to one word: overconfidence. Humans consistently believe they know more than they actually do. Ask a room full of people to rate their own driving ability, and almost everyone says above average. That's mathematically impossible, but psychologically completely normal. The same overconfidence shows up in investing. You feel like you have a read on a stock. You feel like this time is different. That feeling is not information. It's just a feeling. And Odine's research found something almost poetic about how that feeling plays out. Investors tend to sell their winning stocks too early, to lock in the good feeling and hold on to their losing stocks too long, hoping to avoid the bad feeling, selling the winners and keeping the losers. That's the exact opposite of what makes money. So now put those two stories side by side. On one side, a machine that's barely right more than half the time, but never panics, never gets attached, never checks the price out of anxiety. On the other side, a human who has access to unlimited information genuinely believes they're making smart choices and consistently underperforms because of exactly that confidence. That's the real difference. It was never about intelligence, it's about consistency without emotion. Now, does that mean you should just hand your money to an algorithm and walk away? Not so fast, because here's the twist most people miss when they get excited about AI stock picking. Modern machine learning models trained on stock market data have been studied extensively by academic researchers, including a widely cited analysis by finance professors Shihao Gu, Brian Kelly, and Dacheng Xu, published in one of the field's top journals. Their research tested dozens of machine learning techniques against decades of market data to see how well they could actually predict returns. The models did outperform older, simpler methods, but the improvement was modest, not magical. These systems are genuinely better at finding small, repeatable statistical patterns than a human staring at a chart. They are not fortune tellers. They cannot see the future. They're just very good at doing what Renaissance technologies did decades earlier, finding a tiny edge and applying it relentlessly without flinching. That's an important distinction because it changes what letting AI pick your stocks actually means. It doesn't mean handing your decisions to something that knows what's going to happen. It means handing your decisions to something that doesn't feel anything about what already happened. No dread when the price drops, no euphoria when it spikes, no urge to check the number 40 times a day just to feel something. Here's the modern mirror in all of this, and it's the part that actually applies to you. You almost certainly aren't going to build a machine learning model in your bedroom that beats the market. That was never really the point of this thought experiment. The point is to notice what the machine is missing and realize that what it's missing is exactly what's costing you money. It isn't missing intelligence, it's missing fear, it's missing excitement, it's missing the itch to check your portfolio for the fifth time before lunch. Every single one of those very human things is a cost, quietly deducted from your returns year after year, whether you notice it or not. So the real experiment isn't, can a machine pick stocks better than a person? The real experiment is this. What would your results look like if, just for 1 month, you made decisions the way a machine does? Set your rules in advance. Decide what you're buying and when, before your emotions have a say. Automate the purchase so there's no moment where fear or excitement gets a vote. Then don't touch it. Not because the machine is smarter than you, but because it isn't scared of anything, and you are. Because here's what the data keeps confirming. Decade after decade, study after study, from Renaissance technologies down to research on ordinary trading accounts. The edge was never about predicting the future perfectly. Nobody does that. Not the hedge funds, not the algorithms, not the so-called experts on television. The edge is about behaving the same way on your worst day as you do on your best one. A machine does that automatically because it has no concept of a worst day at all. You have to choose to do it on purpose every single time it's hard. So go back to that moment at the start. You holding your phone, staring at a red or green number, feeling something you can't quite explain. That feeling isn't information, it never was. The machine sitting on that server isn't smarter than you, it's just quieter. And the real results of this experiment were never about whether artificial intelligence can pick better stocks than a person. They were about proving that the version of you without the fear, without the excitement, without the need to check one more time, was the best investor in the room all along.